Once again, this is your premium business platform, that's Business Redefined, where we talk about matters policy, especially focusing on matters regarding fiscal policy in this season, where we are talking about matters budgeting, Finance Act, etc. And tonight we are building on to the conversation. Remember, there are new measures which take effect on the 1st of September. In case you're thinking the Finance Act is done with, not yet. So we'll be unpacking that for you. And I'm delighted to be joined on set by Robert Warreru from Ichiban Tax and Business Advisory. Karibu sana.
Thank you very much.
Edna Gitashu from PwC, you're most welcome.
Thank you very much, Julian.
And James from PKF, always a delight to host you.
Thank you, Julian.
Karibu sana. Lady and gentlemen, thank you so much for creating time for this important conversation. Before we delve into that, there's a new sheriff in town at the Kenya Revenue Authority Times Tower, and that's Humphrey Watanga, the 7th Commissioner General, who has taken over from Githimburu, who was replaced by Rispa Simiyu, who was serving in acting capacity. He was sworn in some time last week, and let's just listen in to what he said, which will set the tone for the conversation we shall be having tonight. If we could have that clip, Alosi, play for us.
We're looking to accelerate the technological advancement of KRA so that we can really utilize the great sort of digital leap, digital advancement in technology. In the last sort of few years, even in the recent past, you've seen what has happened in the area of technology. We now have machine learning modules, we have big data analytics, we have artificial intelligence. So ours is really to see how we are going to harness this advancement in technology and bring that to the fore to really help simplify the tax administration process and just make the tax experience process for the taxpayers much more palatable so that we can drive compliance, facilitate enforcement, increase the tax base, and ultimately reach the targets which, as Mr. Chair put out there, we are looking at going for the 3 trillion target and then growing from there. Put in place a national tax policy. And also the spirit of the Finance Act 2023 was to drive towards tax clarity. So that is a basic premise, that we want to get tax clarity, that you have tax policies that are going to be in place for the long term to provide for that predictability and enable, as you've said, business to have an easy way of understanding what is expected of them from an obligation standpoint.
Right, and that's the new KRA Commissioner General, that's Humphrey Watanga, the 7th Commissioner General, I should clarify for that. And Robert, let me start with you. Some have characterized his appointment as a wild card. Do you share that view?
Well, Julian, that's an interesting perspective. Certainly, he is what you would call an outsider, not having come from Revenue Authority, as it were. Unlike the past instances. You remember the 5th Commissioner General, who was John Jiraine. Githimburu himself was an insider. So this is possibly one of the few outsiders that we have seen. But still, when you look at the history of Revenue Authority, we've got people like M.G. Waweru, who was an outsider, and he was quite a transformative CG. So it's an interesting one, and just listening to him there, he's got quite a bit on his plate that he's promised to do.
Edna.
Yeah, thanks, Julian. So first of all, I wish him all the very best in his new role. And the advantages of having an outsider vis-a-vis an insider, as Robert has said, an outsider will be able to look at things from a different perspective, and maybe this is what we need at this point in time.
All right. James?
Yeah, thanks, Julian. I think the new CG will be faced with the same challenges any CG has been faced with. And this is obviously based on the fact that there's the need for revenue collection. I think the inner workings of KRA will remain as they are. And I believe his stewardship then should be able to guide that role. But we can be able to pick two major issues that he's sort of emphasized. There's the issue of technology.
Yep.
And we'll actually be seeing some of these amendments effective 1st September, geared towards technology and enhancement in compliance. And the issue of the national tax policy, which is something we have always been crying for. But will it be actualized? Because I think it's been a never-ending story over the last couple of 2-3 years, with no actualization of the national tax policy.
Okay. Now let's get into the substance of what he spoke about. Let's start with what James has already mentioned there. Robert, technological advancement seems to be the anchor of his agenda. Just how much can he push this agenda?
Well, let's start by saying the law as it's currently worded, effective 1st September, has got very expansive provisions around data management for Revenue Authority. And I think it's important for our viewers to understand that this has been something that's been in the works for a very long time. Revenue Authority has actually been collecting a lot of data. You had the new Commissioner General talking about big data. Yeah. So they've been collecting a lot of data. And in fact, if you look at the statistics about the performance of last financial year, one of the drivers that underpinned the growth in VAT was data collection. Yeah. You've got a lot of data that is being collected by Revenue Authority, being analyzed, and then they have very targeted interventions. And that's what the Commissioner General is talking about. Now, like James said, one of the key changes that is taking effect 1st of September 2023 is that Revenue Authority can ask a taxpayer to submit certain data. And Julian says it's very interesting data that people will be asked to submit. This includes the name of the person who you're paying, what you're paying for, their address, how much did you pay them, and so on and so forth. So Revenue Authority will be collecting quite a lot of data. And what that tells us is that it will be very targeted interventions by Revenue Authority. It will be a risk-based audit, so that if Julian's is providing us this kind of data, we know that he's paying Robert X amount, and we expect that Robert will be will be declaring this. So when you hear the Commissioner General talking about big data analysis, and remember, this is somebody who's worked with the Commission on Revenue Allocation, yes, so he's seen all the data. And if you look at his resume, he says that leveraging technology. So it's very clear where he's going with his agenda at Revenue Authority. And I think that particular provision gives him the tools to do that. So definitely they are on the right track in my view.
Edna.
Yeah, I do share the same sentiments as Robert. So there are three things that he's talked about. He's talked about tax base expansion. It's something as a country we have been talking about for a very long time. And I believe that technology is going to help us with this. As Robert has said, there's a provision around data management and reporting system. Yeah. So what is going to happen is that the Revenue Authority is going to be collecting data, transactional data, from taxpayers. And from this transactional data, they can be able to compare and see, have you been able to declare all your tax obligations? So in so speaking, they're going to be able to expand the tax base, making sure that all the taxpayers are paying their fair share of tax. The other thing he talked about is facilitating compliance. If we embrace technology, it makes it very easy for us to comply, because you don't have to leave your office, you just have to file returns online. Hopefully even the help desk will also be online, working 24 hours, so that we can get the much help that we need. And thirdly, and most importantly, he did not mention this, but I think that there's a case for sealing of revenue leakages. Yeah. And especially now, the Revenue Authority may not necessarily have to wait for comprehensive audits. With the use of data analytics, they can be able to flag transactions that are probably of high value and transactions that pose a risk to the Revenue Authority if taxes are not complied with. So it's going to enhance the revenue collection, in my view.
I see. James, your thoughts?
I cannot echo what my colleagues have mentioned there, but maybe just to give a history so that you can actually see where we are headed.
Yeah.
Some years back, many years back, we used to queue at Times Tower with tax returns for them to be stamped. Then we moved to something that was called ITMS, the Integrated Tax Management System, which was a fair attempt to automate. Then around 2015, we had iTax, which was almost full automation of all the domestic taxes, for that matter. Then shortly after that, there was no emphasis on the VAT auto-assessments, the VAT inconsistencies. So there was that move towards making sure there's a visibility from both the sellers and the buyer side to make sure that there's no misdeclaration and no leakages. Then shortly after that, there has always been emphasis on, for VAT purposes, you have to produce a ETR report, the Z reports, to actually confirm actual sales against what is declared. Then e-TIMS came in, basically the electronic tax invoice management system, which has not even lasted for a year or so. Now we are talking of TIMS. Sorry, so we
From
basically
teams to
with teams,
e-teams.
then
Yes,
e-teams,
correct.
basically e-teams. And you can see the way e-teams is now fashioned. For any person who is VAT registered, you're actually required to be on e-teams. And you see the confusion has been, what is the interplay between accounting systems that are being used by taxpayers and e-teams? Is there confusion? Is teams going to be continued? What is the status of all the gadgets and devices that everyone invested in?
Yeah.
So there seems to be a confusion, but in actual sense, there's no confusion. I think what needs to happen is a lot of sensitization. There is no duplication or replication of what you have in your accounting systems. It's just a connection that e-teams is just plugging in to make sure that there's a visibility. And what Robert has mentioned is critical. Because for everyone who has basically onboarded on e-teams, you will actually notice that the amount of information you have to provide is actually quite substantial, including a simple thing as whenever you raise a credit note, you need to give a reason as to why you are raising the credit note. Yeah. So you can actually see it is a full-scale automation. And I think data, here we are talking about data, we'll head to big data. Yeah. And that one is actually what will be key for the Revenue Authority.
I see. One thing which you spoke about, and let me now start here with Edna, is the national tax policy. Are you optimistic? This is a conversation we have had ad infinitum, perhaps, and we have argued that we have seen bits of it coming through the Finance Act that is currently in place. Are you optimistic, Edna?
So we saw the first draft national tax policy last year, sometime in July. Then after that, early this year, there was some form of public participation on the draft. We understand that it was updated and submitted to the National Assembly. I think the next step would be then to make sure that our tax laws are actually in sync with the national tax policy, so that it's not just a document on its own, a standalone document. And one of the advantages of having a national tax policy is making sure there's predictability. And the CG, the new CG, has talked about predictability. Yeah. Investors are in the country for the long term, and they're making long-term decisions. The challenge we have had is that we have had tax laws introduced in one Finance Act, 2-3 years down the line, they have been repealed, and perhaps that is what the investors base their decisions on. So we really hope that this is going to be actualized, and we are going to align it with our tax laws.
All right. Robert?
Yeah, certainly, and I agree with Edna's comments, and perhaps the best example to give there is around exported services. June 2021 exempted, June 2022 partly subject to VAT because of the business process outsourcing. Yeah. June 2023 is now zero rated, which is fantastic news for us as businesses. But that's a clarity that Edna is talking about, and I do agree with her that if you look at the history of the national tax policy, it actually stayed for a very long time before it became a public document. And in the last 12 months, we can clearly see a sense of urgency on the government's part to make it public and to even table it, because now it's now been published, and I think it was tabled before Parliament. So I think starting the next budget cycle, we should see some of these policy pronouncements in the national tax policy coming through the Finance Act and all other amendments of the law as relates to taxes. So I am optimistic that it will come through, Julians.
James?
Yeah, I think on the issue of the national tax policy, and this is more from an investor point of view, the uncertainty that comes with the tax environment in Kenya is actually what needs to be addressed. It can be a very pretty, lovely document to read, but if investors do not feel that they have the confidence to actually predict and to be in a position to easily manage their tax affairs, then that document is dead on arrival.
I see. Yeah. And now, with that said, now let's get into the substance of September 1st, 2023, and some of the measures which are coming into force. And let me start with one which I've received tons of questions about. And let me just remind you, Section 52, and I think also 64, I saw it there, the provision that the Commissioner may establish an electronic system through which electronic tax invoices may be issued, and the provision establishing a penalty for failing to comply with electronic tax system. Let me start with Edna. In very accessible terms, what does this mean?
Yeah, so Julian's previously, and I think James mentioned this, previously we had electronic tracking or electronic tax registers from a VAT perspective. Then we moved away from ETR to TIMS.
Yes.
Then now e-TIMS. So the whole idea is that now eTIMS is not only going to be applicable from a VAT perspective. eTIMS is going to be applicable also from an income tax perspective. So what does this mean? From 1st of January 2024, if you want to support your expenses, your income tax expenses, they must all be generated or supported by an electronic tax invoice, in absence of which, then you cannot take a deduction for that expense. So what are the implications of this? Obviously, we have a few exemptions in the law. If you're probably paying salaries, emoluments will be exempted from that. Or if you've imported goods and services outside the country, that's also exempt. If you have interest, it's exempt, and a few other items are in the law.
Yeah.
But the implication is that if I am doing business with Julian's, Julian's is a big company, and maybe I'm in the micro, small, and medium enterprises. I was not registered for VAT, and I therefore did not have eTIMS.
eTIMS, yes.
But now, because I'm trading with you, I will be forced to then embrace eTIMS so that I can be competitive. Because remember, if I am not registered for eTIMS, and my friend here, Robert, is registered for eTIMS, all of a sudden it will be more attractive for you to do business with Robert as compared to me. So this is going to make sure that everybody in the tax ecosystem then complies with eTIMS, and to ensure that we are expanding the tax base. But there are a few challenges. One of the challenges that I do see is that from an accounting perspective, we embrace accrual. What does this mean? At the end of the year or at the end of an accounting period, what would happen is that if I have not received an invoice, but I know the service has been rendered or the goods have been supplied, and I have a contract, then I'm allowed to accrue for that expense. But now here is the law saying, for you to get a deduction, you must have an electronic invoice.
Yeah.
So there's a bit of mismatch there, and something that probably we need to think through even as we implement eTIMS. And this is part of the technology that the new Commissioner General was talking about. Is it something new? No, it is not. We've also seen other countries such as Rwanda embrace this.
Okay. And Robert, the question that has been thrown at me is, in the event that, you see the scenario Edna has given, if I am a small business dealing with you as a large business, let's take a scenario where neither of us had met the threshold for VAT in the first place, and now we are in this scenario where, will this apply to us or not?
That's a fantastic question, Julian. And I think it's so important that everybody understands that it has nothing to do with your VAT registration threshold. So previously, as we knew, teams or eTIMS now was always about people who are VAT registered or people who have gotten to the VAT threshold. So meaning that you needed to have made supplies valued at 5 million shillings or more in a year. That was for VAT purposes. Remember, these changes are coming in under the Tax Procedures Act, which is an administration act that empowers Kenya Revenue Authority to administer the tax laws. And what this provision is saying, everybody has to be on eTIMS, and this is the data that the commissioner will be collecting and analyzing. So to answer your question, it has nothing to do with your VAT registration threshold. You could be a supplier who is only supplying goods worth 500,000 shillings in a year.
Yeah.
But for that invoice to be accepted as a basis of an expense in Edna's books, it's got to come through the eTIMS machine. So it has you don't have to have met the threshold. Basically, what this provision is doing is everybody who transacts will have to go through this if you want to be competitive, like Edna is saying, whether or not the value of your supplies exceeds 5 million.
James, I've been asked whether this provision will precipitate a compliance nightmare, as it were, when it comes to a taxation perspective.
Definitely, Julian, it will. And the reason is because we've interacted with eTIMS. And the many details Robert mentioned, those details have to be provided. PIN number of whoever you are invoicing, basically your customer, including their physical addresses, what you're supplying, and basically the amount of what is being supplied. It's more of a build-up to what ordinarily we file on a monthly basis from a VAT point of view. But then you'll notice the eTIMS will sort of be running in parallel with your accounting system. And this addresses the concern that many people are asking. So what does eTIMS do to the way a business internally manages its accounting system and generates its invoices? So what will happen in the eTIMS platform, you'll notice that you'll be required to provide the invoice number that you want to generate on eTIMS. And that is the invoice number that is in your accounting system. But then the moment you do that, eTIMS will also generate a unique number. Now, that unique number is the number that will be sitting on the eTIMS platform and the invoice that KRA will have a visibility of.
Yes.
And you see what will be happening in terms of for any person to claim the input VAT, they'll have to be relying on that unique number that is I believe it's being called the control unit number.
Yes.
That is the number they should be claiming so that the same matches with the invoice that is already sitting on the eTIMS platform. So you can actually see the amount of work that will come. There will be that report that is being generated from the accounting system. Then there is now the extra exercise of coming to make sure that for each and every of those invoices that are generated, there is a corresponding eTIMS invoice that has been generated. So you can actually see the amount of administrative work that will come with that.
Are unpacking the provisions for Finance Act 2023, which take effect on September 1st, which is not too far. It's just actually on Friday this week. And we are once again on set with Robert Warero, Edna Gitashu, and James Mulili from PKF. Asanteni sana for being here. Right before the break, we were discussing the provisions around electronic tax invoices and what the provisions mean for taxpayers. So many questions coming online. Let me start with you, Edna. Someone here is asking, for those of us who play within the league of the turnover tax, and just for the sake of the viewers, turnover tax now revised to 3%, and the band, of course, squeezed from the initial 1 million to 50 million to 125 million. What does this mean for them in terms of tax liabilities?
So, Julians, to the extent that you're under turnover tax regime, and basically turnover tax, as you have said, is based on the top line. That is 3% of the top line.
Yeah.
If you're under that regime and you're trading with other people under the turnover tax regime, then you probably may not have to comply with eTIMS. But if you're trading with bigger businesses or any business that is actually not under the turnover tax regime, then you will be forced to actually comply with eTIMS so that these other businesses will end up taking a deduction, a tax expense. So what I see in the near future is that inevitably everybody is going to be caught up under eTIMS.
I see. Robert, you want to add on to that, or we go on to the next question?
Well, no, I think the only thing maybe perhaps to add on to that is that there's a very punitive penalty regime for people who don't comply with eTIMS regime. And actually, the commissioner is required to give you a notice to explain why you have not complied. And if that explanation is not satisfactory, then the penalty of 2 times the tax due is imposed. And I think it's important because the powers of the commissioner to waive penalties and interest were removed.
Taken away.
So
Correct.
it's so important for everybody to ensure that they comply, because twice the amount of tax involved could be a substantial amount, and you'll have to end up paying.
There are 2 Kenyans who are watching this and saying the elephant in the room is the fact that MSMEs in this country are invoice rich and cash flow poor. And what does this mean for them? Because if the financial year ends and you haven't been paid for any of these invoices you issued, yet KRA on the other hand has received all the visibility that this transition enables, what does it mean for them? James?
It's quite an unfortunate situation because actually the end game on these eTIMS, especially from a VAT point of view, is the fact that we should get to a position where your VAT return is auto-populated by the time you file it.
Yeah.
There could be small human intervention here and there when it comes to issue of, for example, the restriction of input VAT. That might need your intervention. But I think overall, the fact that these eTIMS invoices will already be on the system, basically there will be the issue of auto-population of VAT returns. And that's why I've said it's an unfortunate event where I believe all businesses will have to pay the taxes, whether they've received the money from the customers or not. And as a mitigation measure, that's why we have a provision in the Tax Procedures Act that allows for a refund of any taxes that have been paid and any debts happen to go bad, where you don't get paid. But then that's quite a painful process because you have to wait for at least 3 years from when you supplied to be in a position to even lodge that refund application. So in terms of cash flow constraints, this is going to be a very live case. And maybe just to add to what Edna mentioned, even for people who are playing between turnover tax to turnover tax, remember there's a VAT obligation that even for the guys under turnover tax, if their sales are more than 5 million. So I believe indirectly, even for guys who are playing, for example, within turnover tax regime, there will still be a need for e-teams, because forget about the issue that they cannot claim the expenses, or they are not required to claim any expenses from an income tax point of view, because turnover tax is on the top line. VAT then will force them one way or another to also comply with the e-teams.
I see. Edna, MSMEs are said to be invoice rich, cash poor. Do you see a challenge with this, given this provision?
Yeah, so maybe just to build up on the conversation that James has introduced, to the best of my understanding, all taxes are payable not on actual cash receipts, but actually on accrual. If you think about it from an income tax perspective, from a VAT perspective, to the extent that you have already rendered this service, then you don't require to have received the cash for you to make the payment. So that's a structure of our law. And I think what we are now saying is that we already have that in the law. We are just making sure that we are enhancing compliance by bringing in a system. So I don't see a major departure. Probably the only issue that they would have, and not just the MSMEs, but even the larger businesses, at the end of the year, you have accrued for this expense. Remember, we said tax is also an accrual. So you have accrued for this expense, but then you're not allowed to take a deduction for the expense. Why? Because you do not have an electronic tax invoice. So this one is not that you don't have the cash. You don't have the electronic tax invoice. So that is going to be a challenge, because the accountants will be saying you need to match your expenses and your revenue within a particular accounting period. But then the taxman is saying, hey, no, you don't have an electronic tax invoice, so you cannot take that as a deduction. So that's a challenge that I see for all the businesses.
Robert?
Yeah, and I agree with my colleagues here. Probably what we are likely to see as a practical consequence of this, Julian, is that a lot of people will start negotiating their credit periods. And I'll tell you that for me to work with you, you need to pay me within 30 days. Otherwise, I have a serious problem.
Exactly.
I have a serious problem from a cash flow perspective. So, and probably this is something that we have seen in more developed countries where bad debts are. It's not a very serious problem. Probably in Kenya it was a bit of a problem, because anyway I could take the expense without the need for proving the expense. So likely that will be a practical result of this as more people now start feeling the squeeze. And the truth of the matter is that if she's feeling the squeeze as a supplier to me, and I'm also feeling the squeeze, then I'll need to pass on the love to you.
I see. I see. Yes, you wanted to add something, James? Or?
No, thanks. I was just reacting to Robert.
All right. In the interest of time, let's switch gears. In case you have any further questions on this particular provision, please just bring them in. We shall take them as we close this conversation later on. But let's look at something else. Section 56, the provision introducing Section 37E on the commissioner refraining from recovering interest, penalties, and fines. That is the amnesty provision. First of all, an intro 101. James, what does this mean?
So, yeah, thank you, Julians, for this. And I think this is one of the welcome provisions in the Finance Act. I think we've all been talking negative. I think this is a very good provision. Number one, in this sense, there are a lot of businesses that have been carrying contingent liabilities in their books. And this is related to very historic tax arrears that they had, and they went ahead and actually paid the principal taxes. And what the law really allowed any taxpayer to do was to apply for a waiver of the accrued penalties and interest. The unfortunate thing is that in the past, these waivers have not been approved. And the question that has always lingered has been as and when the CS National Treasury, for example, approves any penalties and interests in excess of 1.5 million, then there would be the requirement to actually pay the penalty and interest to the extent of what has been approved as a waiver. So there is, number one, a cure to these all historic waiver applications that have been sitting at KRA. Now, the other thing is, and maybe this was in preparation to this amendment. 2 or 3 months before the finance bill, KRA actually started reaching out to taxpayers, especially those taxpayers who had made waiver applications.
Yes.
And they put a proposal on the table. We'll waive 40% of the penalties and interest. You pay the 60%.
Yes.
And there was a lot of question about the enforceability of those proposals because of the form and manner in which they came. Ordinarily, those letters were supposed to be from the CS, National Treasury. And you see, there was that debate. Is it enforceable by KRA? Is it not? Many people reacted to it, obviously depending on the materiality of the penalties and interest. Many people decided to go silent. But what we've actually seen over the past couple of weeks is KRA trying to enforce. And for anyone they wrote to with the 60-40 proposal, they're asking or demanding for the 60% amount. So I think for anyone who has not received such communication, I think come Friday you should be very happy, provided you lodged a waiver application and say this thing should be extinguished. But
that is for the year ended 22 going
back. Yeah. But then the question now is in terms of application. Remember, these penalties and interest are sitting on the iTax platform. So will it be, is there an arrangement within KRA such that these penalties and interest will be cleared automatically on the iTax ledger? So there is that issue of how does that work? Now, so that really addresses those people who had actually paid the principal taxes as at 31st December 2022.
Yes.
Now, one thing that people also need to note, and I think that has been mentioned by my colleagues, going forward, there is no longer going to be waivers of penalties and interest. So you have to contend really with what is accrued in the form of penalty and interest. But there is a reprieve. And I choose to look at this like a sort of a grace period, because then it talks of if you had not paid the principal taxes as of 31st December 2022, you are given certain conditions where you need to make an application to the commissioner, enter into a payment plan of the principal tax, a payment plan that does not go beyond the 30th of June 2024. And if basically that payment plan is ratified, you get the penalties and interest waived in full. So you can actually see this is sort of a provision to entice businesses to make sure that they clear any principal taxes that have not been paid. And that's why we choose to look at it as a very welcome provision. But then again, there is now the issue of the already existing voluntary tax disclosure program. This looks more lucrative than the voluntary tax disclosure program, because we're in the last year of the VTDP, where you only get 25% waiver. So we are likely to see a departure and most people moving towards taking advantage of this amnesty.
Actually, Edna, that point is a good segue to my question, which I was going to ask. So we have the VTDP in place, we have the 60-40, which is already mentioned, and now we have this. And the question that emerges is, do we expect any form of guidelines as to how this will now coexist?
Yeah, so Julian, I think the answer to your question is yes. This is one of the provisions in the law where we expect the Revenue Authority to give us guidelines on how to comply. But just allow me to add on to what James said. So there are benefits also to the government to have this amnesty program, because the government has been carrying debts and they are not sure whether these are bad debts or not. So now it's the government's turn to also take this opportunity to clean up. How did some of these debts arise? Besides the scenario that James has talked about, we've also had changeover from manual system. We went to the integrated tax management system. At that point in time, we had returns being filed in parallel. So there are some taxpayers who had actually filed their returns manually, but on ITMS, there are penalties because of late filing, or it is not the system did not recognize that the principal tax had been paid. Then we moved from ITMS to a higher version, that is iTax. Again, there were system changeover issues. So it's a good opportunity also for the taxpayers and the government to be able to clean up their records where that is concerned. And the other point that James talked about is that it's also a way of encouraging taxpayers to pay. The government is also managing its own liquidity to make sure that they meet their target. So how do they do that? If you have any liability sitting on iTax and you have not paid that, then it's your opportunity now to come forth, discuss this with the Revenue Authority, and then agree on a payment plan.
Yeah.
So my expectation to your earlier question is that if you have an outstanding principal liability, then you'd have to get into an arrangement with the Revenue Authority. But the Revenue Authority would then need to give guidelines as to what will happen to the legacy issues. Will it require for automatic approval, or do I still have as a taxpayer to go forth, to come forward and give all my documentation to show that I had paid my tax and filed my returns within the time stipulated in the law?
Robert, anything to add on to this? And as you add your point, the question here is, someone is asking, suppose I receive an assessment post-September 1st for the year ended 31st December 2022. Am I still eligible for this?
Yeah, I think let's start with that question, Julian. In my view, you are eligible because you've gotten an assessment that perhaps says you had some outstanding taxes before, let's say, you got it in September. So even as late as July or August this year. So the question is, do you have a principal tax that you have not yet paid as at 30th June 2024, and that you're looking to pay, like James said, you meet those conditions, you apply. And I think it's important to just clarify there that, so before 31st of December 2022, it's automatic, at least the way the law is worded. You don't need to do anything. But if you've not paid the principal tax after that date, then you need to move the commissioner. I think the only other thing that I would want to add, Julian's, from what my colleagues have said, is that there's sort of like a spanner in the works that's been thrown here, because there is a proviso to that section that says that amnesty does not apply to a Section 85 penalty. Now, Section 85 of the Tax Procedures Act is about tax avoidance. And we've always had a challenge because tax avoidance is legal, tax evasion is what is illegal.
Yes.
So, philosophically, one could ask, but if I arrange my affairs in such a manner as to avoid the tax, is nothing wrong with that. So if you've caught up with me as Revenue Authority and I want to take advantage of the amnesty, surely I should be allowed to take advantage of the amnesty. So I think there's a bit of a misalignment there in terms of the way the law is worded, because I believe that tax avoidance, whereas it's frowned upon, is not illegal. There's nothing illegal about avoiding your tax liabilities.
All right, and that point by Robert takes us to another break. I'm told we have to take it at this point. We shall be right back with the few more sections remaining as far as September 1st is concerned. So stay tuned and keep your questions coming. We shall be taking them. Welcome back to this conversation where we are digging into the measures in the Finance Act of 2023, which take effect on Friday, that's September 1st, and we are continuing with this conversation. Thank you so much, Edna, Robert, and James, for joining us for this illuminating discussion. So many questions coming online. We have just been discussing the issue of the amnesty that comes in courtesy of the Finance Act of 2023. And now we switch gears to something which has been touched on earlier, and that is Section 63, dealing with the provision on the establishment of a data management and reporting system. And this is something which has stoked so many questions. Edna, maybe you can just give us some thoughts around what this actually means in terms of what it means for taxpayers.
Yeah, so Julius, we've been talking about the electronic tax invoice management system. So the Revenue Authority is going to have visibility of the transactions of taxpayers, and they'll be receiving this information on a real-time basis. So what this data management and reporting system is seeking to do is that in instances where the Revenue Authority has used technology and for one reason or another, they have realized that there's probably one of your transactions is off, then this provision of the law empowers the Revenue Authority to ask for specific data. They're calling it transactional data on that particular transaction. Maybe who did you pay? Did you account for the taxes, etc., etc. And this is one of the ways of sealing the revenue leakages and making sure that the taxpayers are paying their fair share of tax. So before this introduction of the provision, we had the comprehensive audits under Section 59 of the Tax Procedures Act. The Revenue Authority would then be asking for periodic information on taxpayers. But now we are moving away from that, the periodic information, to real-time transactional data on taxpayers. So this means that by the time maybe they come to do a comprehensive audit on you, they already have a lot of information on you.
James, this gives a very interesting prospect here. And the question being asked is, will they have full visibility of all my transactions all my inventory, or how will this work?
Yes, and the answer to that is yes. They'll have full visibility. And if you look at the wording, if I may read it verbatim, the commissioner may establish an electronic system through which electronic tax invoices may be issued and records of stocks kept for the purposes of this act. So, and you see in a nutshell what taxpayers are being told through this provision. The movement in your stocks will be within the KRA's purview.
Yes.
So from your opening balances to your purchases to your closing stock. So basically, your inventory, this system will almost replicate what you have in your accounting system.
Yes.
And have a module to actually regulate your inventory. And actually, if you think about it further, for businesses that deal with inventory, even from the income tax side of things, when you look at the income tax return that is normally populated, there's actually a worksheet in that return where you're supposed to actually key in the movement in stock. It is only that, and we understand where KRA is coming from. If there is one very dirty part of the profit and loss account, is normally the cost of sales or cost of goods sold.
Yeah.
So you can actually see where they are trying to target so that they immediately have a visibility of your inventory movement.
Robert, someone is asking online, is this something similar to what has already been implemented in the betting sector?
Not quite, in the sense that the betting sector is very limited to excess tax and withholding tax on winnings. That's what they report on a real-time basis. However, the person is actually correct in the sense that Revenue Authority has seen the benefit of real-time data access. And like my colleagues have said, what Revenue Authority will be doing is getting that data. And you know, if you look at that provision, it says that the commissioner can ask for or can designate any other transaction which is commercial or financial, meaning you don't even have to be getting a benefit. To the extent that you're giving somebody freebies, the commissioner can still ask you to designate or to provide information about that. So essentially what the commissioner is saying is, I want to be able to see your transactions immediately they happen. I want to know who you are dealing with. And a lot of people have been asking, you know, will KRA be accessing M-Pesa statements and so on and so forth? With this kind of a provision, KRA doesn't even need to access your M-Pesa statements, because anyway, they are getting your transaction data from everybody else.
Yes.
So why do they need your M-Pesa statements? So the person is correct in the sense that it's real time. It's happening instantaneously as the transaction happens.
And there's a question being asked here. Is this a data management system that is already in place or it is going to be set up? You know, September 1st is not far.
That's a very interesting question. So we already have eTIMs, and we have taxpayers that have been onboarded. So this data management and reporting system, I believe, is already in place. Perhaps what the Revenue Authority might be thinking of doing is enhancing it so that they can be able to have visibility of these transactions. But to answer your question, I believe it is already in place.
Wow, I see. And to the question that is being asked around the integration of this with various businesses, I think it's being addressed by the issue around eTIMs. The earlier conversation we had around eTIMs and the requirement that businesses will be required to have integration with their systems nonetheless. So someone is asking, do we actually have the capacity to process all this data? I don't know who will take that. I know no one holds brief for KRA, but yes.
Okay. James. Okay, I believe the government must have invested, and we're actually deliberating before the show. I think Edna mentioned that she saw an expression of interest. Basically, you see, for you to have a very scalable data management system, then you need a very robust data center, or what in IT terms is called a data warehouse. And I think the expression of interest Edna was talking about was to actually get suppliers who can be able to provide data warehouses.
Yeah.
So that in itself is already communicating a very deliberate effort and intention and an availing of resources to make sure that all the systems are in place to actually house and have this data management system in place.
Okay.
Yeah.
Yeah, I mean, I agree with that. And I think it's important to also highlight here that it's not something that started recently. Actually, Revenue Authority for over a year has been developing that data warehouse.
Yeah.
So there's been very, very heavy investments around the capacity to analyze this data or to even house this data. And don't forget that under the information sharing protocols that Kenya is a signatory to, part of the things that Revenue Authority has been assessed on in terms of compliance and readiness to share data is your data management system. So, and we've seen cases where Revenue Authority has written to Mauritius Revenue Authority and so on and so forth, asking for data, and that data is being shared. Now, that data can only be shared if the review panel is satisfied that your data management system is watertight. So, in my view, Revenue Authority definitely has the capacity. They have been collecting a lot of data. In fact, even for companies that file their tax returns on 30th of June, there was a requirement for you to disclose whether you've got related party transactions. And if you do, you give us the details. Well, I'm saying us as if I work for Revenue Authority. You give Revenue Authority the details around those transactions, which clearly tells us that Revenue Authority is looking to analyze this data. So for a fact, they do have the capacity, they have invested heavily, and they're continuing to invest.
Edna, I'd like to get your thoughts on this. And as you answer that, just piggybacking on what the example that Robert has given, someone is asking online a very good question. How does this interface with the requirement around common reporting standards?
All right, let me start with that question. On common reporting standards, taxpayers are supposed to file returns at the end of the year, and not all the taxpayers. This is the taxpayers in the financial sector. And what the government is doing is collecting this information and sharing it with other countries on a reciprocal basis. Meaning that if Kenya shares this information with Mauritius, then Mauritius can also share the same information with Kenya. And this is in a bid also to expand the tax base and make sure that you are accounting for all your income streams. So I think that would be separate, but probably gradually as we go on, maybe this is going to be done online as we continue enhancing our systems. To the question around capacity, everybody is talking about technology.
Yeah.
Julian's in your own small way, I'm sure you have technology also working for you. So I foresee that this is one of the areas, and it has actually been talked about, it's there in the budget policy statement. This is an area that the government is going to be focusing on. So I would imagine that if they do not have capacity, the Revenue Authority doesn't have capacity, they are building on this capacity. Previously, we have had audits where the Revenue Authority has conducted manual audits.
Yeah.
In a few years, this should be a thing of the past. All you need to do is they have visibility of your transactions. You just provide evidence, maybe the contracts and all that. We have talked about the provisions of the law requiring that. And maybe they can do these audits from their offices and just go for a field visit. So I think this is the way that not just Kenya Revenue Authority is going, but all the revenue authorities in the world.
Actually, and before we quickly take a break, the question is being asked, is there any other case study where this is in place, such a data warehouse system for taxation purposes? Across the region, maybe. I'd imagine Rwanda being ahead in a number of areas.
Yeah, and Kenya Revenue Authority actually did go for a benchmarking tour to Rwanda, and that's where the E-Teams idea came from. So Rwanda is one of them. I believe Ireland has progressed very, very rapidly on that, and I think Australia as well. In fact, the Australian Tax Office has been sharing information with Revenue Authority, Kenya Revenue Authority. So it's something that's already happening across the world.
We have two issues to discuss. Let's start with Section 10, around the digital assets tax and the corresponding rate. Maybe let's start from here. What's the rate provided for this digital assets tax, and what's targeted? Robert.
Right. So digital assets tax rate is 3%, and this 3% is on the transfer value of the digital assets. So whichever digital assets, whatever platform that you're operating in, you transfer it. You transfer the asset. Whatever transactional value you report is subjected to 3%. So it doesn't really matter whether you're making a loss or gain. And for example, if you've bought say Bitcoin at $100 and then the market crashes and you sell it to James at 90,
you still have an obligation.
That 90 will be subject to 3% tax because it's a transactional tax. And one of the challenges that we've had with this provision is that you're not taxing the gain. Income tax is about taxing the gain, but yes, here you're just taxing the transaction. And so that is a bit of a challenge. Now, people have asked, but we transact on these platforms which are, one, not in Kenya, and two, who will have a reporting obligation. So the owner of the platform actually has a reporting obligation. If you look at the law, they are required to register, self-register, and then report that. And remember, KRA, we've just come from the conversation about KRA collecting a lot of data. So chances are that from your disparate sources, KRA will know that you're transacting in this media. And so they will be looking to the owner of the platform to collect that. And again, in the Finance Act 2023, there's this thing about exchange of mutual administrative assistance, in the sense of we can help you collect taxes and you also help us collect taxes. So I suspect that even for those exchanges that are not in Kenya, the ones that do not register, chances are Revenue Authority will be writing to the respective revenue authorities and saying, we want this person you want you to help us collect this amount of tax. So I think those guys will also be coming into the tax bracket, Gillians.
And in case you're wondering about the self-registration, you might want to revisit the Capital Markets Amendment Bill of 2023. Actually, it provides that persons dealing in crypto will be registering with the Capital Markets Authority. It's still in bill status, so we wait to see the outcome of that. And now the question is coming online about, why are we taxing the transaction value to the point you've made? Why are we not taxing the gains?
Yeah, so Julian, this is actually a presumptive tax. A presumptive tax is a simplified tax regime. So before this change into the law, these gains were actually taxable at the rate of 30%, and it was the gain itself that was taxable.
Yeah.
But here now what the law is saying is that you who is trading, you who is actually selling these digital assets, at the point of the transfer, the 3% of your consideration means that you have to pay that as tax. So what this means is that it is turnover based, and there's a presumption that there's at least 10% profit margin. And that's why the rate is at 10%, at 3%. So the challenge comes in with what Robert has said. I have made a loss. What happens? It means that even though I have made a loss, I still have to pay the tax. I think the other thing is that, as Robert said, you have platforms. How to get these digital assets is through the platform. So the platform owner is going to bring in the buyers and the sellers together. So it's also quite an onerous task to then tell the platform owner to be the one to remit this tax. The platform owner doesn't have access to these digital assets. The platform owner only gets a commission out of it. So we wait to see how this is going to be streamlined and whether KRA is going to give any guidelines on how this law is going to be operationalized.
I see. James, someone is asking here, has DST been so successful that we actually think we should go for the digital assets? And I know you don't hold brief for KRA, man.
Yeah, so I think this is just sort of a spin-off from the intended purpose of DST, because I think there was that realization that there are a lot of businesses and a lot of services that are being rendered through electronic platforms.
Yeah.
And you'll also notice something that happened with DST over time. Remember, DST, when it first came in, it was applicable to anyone, whether you are a resident person or an unresident. That mutated to, or that one rather was changed so that DST is only applicable to non-residents, with a simplified way for these non-residents to even register for VAT. And that's why you'll notice for any digital service providers now, they actually have to account and charge VAT, because then it is assumed that the digital service is actually being consumed or used in Kenya. And you can see the way basically the global environment is going. The issue of settling global transactions. We are now having a lot of cryptocurrency transactions that are happening. So I think there's that realization that in as much as DST came, if you look at the listing of what digital services are, the digital assets in focus here are not part of DST.
Yeah.
But in actual sense, it does not mean that they were not subject to tax. Like what Edna mentioned, you are supposed to actually determine your gains and pay the tax. The peculiar thing with digital asset tax, just like withholding tax, that the person operating the platform has to remit that tax within 5 days. Where I foresee a challenge is that they have actually defined what income derived from transfer or exchange of the digital asset is. And it's basically the consideration received or receivable at the point of exchange, and it is based on the gross fair market value. So I can actually transfer my digital asset to you at value X, but the KRA can actually come and say, we have this comparable that the fair market value of this digital asset is Y.
Yes.
So you can actually foresee there will still be need for a lot of regulations on digital asset tax. In my view, there is still some lack of clarity on this issue of how does the commissioner determine what this gross fair market value is.
I see.
Yeah.
Edna, there's a question here for you. In the event that I flip one of these currencies for a substantial gain, is it CGT, is it digital assets tax, or is it both?
So previously I would have said it depends on the frequency of your trade. But right now with the introduction of the law, it is clear, it is now digital asset tax, and the rate is 3% on the gain. Not on the gain, 3%
On the transfer value.
On the transfer value, yes.
I see. Robert, there's a question here for you around, let me just read this question again. Are freelancers subject to this tax? And I'd imagine by this tax it means DST, not necessarily digital assets.
Yeah. So not subject to DST because DST is about platform owners, deriving a commission for allowing people to use the platform. That's where the DST comes from. However, for freelancers who work with Upwork and such like platforms, to begin with, you are originally already taxable in Kenya because you are in Kenya, you are generating income from Kenya, and you are required to account for tax on that. What these provisions have done is that they have essentially broadened KRA's perspective or horizon into these people and saying, we now need you to account for tax. And what I suspect is KRA will be accessing this data from this kind of sites, Upwork and what have you, and saying, we know, Julians, you have been paid $1,000 to do this, and so we want you to account for tax on that because it's probably self-employment or self-employment income, and therefore you should be paying tax. After all, you're working from Kenya. And remember, part of the considerations for digital service tax is that you're using a terminal that is in Kenya. So we can clearly delineate that income within Kenya, and we're going to subject you to tax in Kenya. That's what the tax man is saying. But obviously, how will they will get that data? I have no idea.
All right, we have 4 minutes to go, so very quickly, export and investment promotion levy. Let's start with James. Your thoughts on this, and maybe just explain to us what the rate is as well.
Yeah, so a very fun introduction in the Miscellaneous Fees and Levies Act. And this is my personal view.
Not PKF's.
I think it's a very discriminatory provision because if you look at it, basically, and the speech, the budget speech, try to give a reasoning why this levy is being put in place, and is basically to promote the local sector. Because you find that it is being levied on importation of certain items.
Yeah.
And the rate that is applicable ranges from 17.5% to 10%, depending on the commodity that's being imported. And you see, the question is, in as much as then the motivation is to promote the local sector, is there sufficiency in terms of supply from the local industry to meet the demands? And a good example is on something like cement clinker. There are a lot of constructions and there's a lot of high demand for cement. Do we have the local capacity to make sure that that need is met?
Yeah.
So penalizing the importation of that could be restrictive. There's obviously the disruption to the industry players because it's a high amount. If you're told it's 17.5% of the customs value, this is actually in addition to all the customs duties that you have to contend with.
Yes.
So you can actually see in terms of the businesses that have genuinely invested without the resources locally to make sure that they have some of these items procured locally. What then does it mean to their future in terms of the cost of doing business in the country?
Edna.
Yes, so for me, I look at it from two perspectives. So the rationale, as James has said, is where we can be able to manufacture here locally, let's do so without importing. But to the extent that some of the products are actually attracting this levy on raw materials, then it means that our cost of production then goes up, and the cost of the final product is going to be higher. So for me, I would look at it in two perspectives. If we have sufficient raw materials in the country, and what we want to encourage is the use of these raw materials in the country, and at the end of the day, the final product will be affordable, then that is fine. But if we do not have sufficient raw materials, examples that have been given by James, then we probably need to tweak it a bit and say we can have the levy, but not on the raw materials, perhaps on the finished product.
Yeah.
So that if I'm importing, say, cement, like in the example that James has given, then I attract that levy of 17.5%. The cement is going to become more expensive than locally manufactured cement. And that is going to be an incentive for us to continue with local manufacturing.
Robert, and we have 40 seconds to go.
No, I think two quick comments. The first one is on craft paper, which is what is used to package things like when you go to hospital and they put for you your medicine, the brown paper. That's craft paper. Do we have sufficient capacity in country? I don't know, and I doubt it. And the other one is sacks. And I think the thing here we have to be very careful about is making it so expensive to manufacture in Kenya, yet in other markets you can still import this product and pay all these taxes and still be more competitive. And there are actually live examples that taxpayers can give. So I think there's something that we need to look at in terms of overhauling our cost of doing business as a country.
Right, and thank you so much, James. Thank you so much, Edna. Thank you so much, Robert, for your insights on this conversation. Unfortunately, we have to close it at that point where we have been discussing the measures which take effect on September 1st, that is Friday this week, courtesy of the Finance Act of 2023. So let's wait and see. We shall unpack this a lot more on our various platforms, whether it is NTV Business, Daily Nation, Business Daily. So keep in touch with those various platforms. News is up next.